Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. That's where I dive deeper into all of these topics and subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. I'm a long-term investor. I look for value in the markets, hence my name, Finding Value. And that is what I'm sharing on the website. We do have a special coupon code. Special is that coupon code. If you'd like to try it and join, you can see in the description link the special that's going on. So Weimar Silver Baron says Trump is pumping crypto to keep liquidity away from gold. We are nowhere close to our repatriation goals. Gold is all that matters on the geopolitical stage. Crypto is a sideshow. Besant is hell bent on this for some reason. He knows about the issues on the long end like I do, like he does. So is crypto a way to keep liquidity away from gold? I think it is to some degree. It was created right in 2008, right when that crisis occurred. It was released, and maybe they're setting something up. I don't know. Tough to say. Breaking Q1 GDP now forecasts has dropped to minus 2.8% from minus 1.5%. So now we've got forecasts of a potential drop going negative in gross domestic product. I was thinking, is this all being done on purpose? Are we going to get a slowdown here based off of what Besant and Trump want? So I did ask a bunch of questions into AI, and we're going to go over that here pretty quick. But let me just kind of talk about it real quick here. I've heard a lot of stuff coming from the news, and a lot of news being released here just recently. And I wanted to kind of go over all that with you guys. So what I did is I went to artificial intelligence and said, okay, let's play the game here. I said, and let me move this over so you guys can see it a little bit. There. It says, are GDP numbers made up? It says, no, GDP number are not made up in the sense of being completely fabricated out of thin air. They're calculated by governments and international organizations using established economic methods and data sources like business surveys, yada, yada, yada. So GDP isn't perfect. It's an aggregate measure, so it can miss nuances like underground economies, think cash-only gigs, illegal trades, and what. So then I went on and I asked, isn't the consumer price index adjusted by hedonic adjustments and substitutions making the number irrelevant? It says you're hitting on a real critique of the consumer price index. Hedonic adjustments and substitutions effects do tweak it in ways that can make it feel disconnected from everyday experience. Let's break it down. Hedonic adjustments try to account for quality changes. If a $1,000 TV today has 4K resolution and smart feature, while a $1,000 TV from 1995 was bulky CRT, the CPI might say you're getting more for your money. So inflation looks lower. Critics, like economists who lean towards raw pricing tracking, say this underplays the actual cost of living increases, especially if you're just trying to buy essentials, not fancy upgrades. Substitution adjustments assume people swap goods when prices spike, like buying chicken instead of beef if beef gets pricey. The BLS uses this in some CPI versions, like the chained CPI, to reflect real behavior. But if your budget's tight and you're already on the cheapest options, that flexibility is a myth, and the adjusted CPI can seem to downplay inflation's bite. Does this make CPI irrelevant? Not entirely. It's still a solid benchmark for broad trends, wage contracts, and policy, but it's not your personal inflation rate, etc. So then I went on to ask, if inflation is understated using consumer price index tricks, wouldn't that mean GDP is overstated? It says you're onto something sharp here. Yes, if inflation is understated due to CPI tricks like hedonic adjustments or substitution, it can be absolutely juice up real GDP numbers, making economic growth look better than it might actually be. Here's how it connects. Real GDP is nominal GDP, which is raw dollar output deflated by an inflation measure, often tied to CPI or a similar index like the GDP deflator. If CPI underreports inflation, say by over-adjusting for quality or assuming you're happily swapping steak for spam, then the deflator is too low. A lower deflator pumps up real GDP since you're dividing nominal output by a smaller number. In short, understated inflation equals overstated real growth. For example, if nominal GDP grows 5% and CPI says inflation's 2%, but it's really 4% without adjustments, official real GDP is 3% if the true inflation were used. It dropped to 1%. That's a big gap, enough to turn solid growth into meh. Critics like John Williams at Shadow Stacks argue that it's been happening for decades, with CPI tweaks masking weaker growth since the 1980s. Mainstream economists counter the unadjusted metrics, overstate inflation by ignoring real improvements, like how your phone's now a computer, camera, and GPS in one. Both sides have a point, but it depends on what you're measuring, textbook GDP or boots on the ground buying power. So then I asked, I'm just like rolling this through. Is Trump trying to initiate a recession to get a weaker DXY, lowered interest rates, and can do this by playing with GDP numbers? There's no direct evidence that Donald Trump is deliberately trying to spark a recession to weaken the US dollar, lower interest rates, or manipulate GDP numbers as of March 3rd, 2025. So let's unpack this step by step. Trump's stated goals since taking office in 2025 lean towards boosting growth, not crashing it. He's pushed for tax cuts and all of this other stuff, yada, yada, yada. The weaker DXY angle doesn't fully line up either. Trump's griped about a strong dollar hurting exports back in 2019, and there's a yada, yada there. Interest rates, Trump's been vocal. He told Reuters he wants the Fed to cut, claiming he knows monetary policy better than Powell, but the Fed's independent and with inflation at 2.4% above 2% target and growth humming. They're holding steady after 1% cut in 2024. A recession would force their hand. So look at a recession would force their hand. Rates dropped to near zero in 2020's crash, but engineering one just to bully the Fed seems a roundabout when he's already got political megaphones. Now, playing with GDP numbers, that's trickier. Real GDP is enough. Okay, and we already went over that. Could he accidentally trigger recession? Maybe. Tariffs and deportations, 5 million workers out could slash GDP 2.5%. Might cool things too much, especially if consumer confidence already dipped to that, and so on. So then I put in there, did Scott Bessent say that it is Trump's economy in 6 to 9 months? Scott Bessent, Donald Trump's Treasury Secretary, has been quoted as saying that it will take 6 to 12 months for the economy to be fully become Trump's economy. This sentiment appears in multiple posts on X and aligns with the reports from late February 2025. I actually saw him say that in an interview, where he suggests a transition period before Trump's policies fully shape economic outcomes. For instance, in a Bloomberg TV interview referenced on X, Bessent reportedly indicated that government spending cuts and shift to private sector growth would align perfectly at first, hinting at a GDP contraction during this shift, with the economy reflecting Trump's influence in 6 to 12 months. Bessent reportedly indicated that government spending cuts and the shift to private sector growth wouldn't align perfectly at first, hinting at a GDP contraction during this shift, with the economy reflecting Trump's influence in 6 to 12 months. Do you see what they're doing here? There's no widely cited verbatim quote from Bessent specifying exactly 6 to 9 months in available sources. The 6 to 12 month range seems to be the consistent time frame he's referenced, as noted in the post from that and Geiger Capital on that. The 6 to 9 months phrasing might be a slight misrecall or narrowing of this broader 6 to 12 month estimate. So to clarify, Besant didn't specifically say 6 to 9 months based on available evidence. 6 to 12 months is what he used, which could be the confusion stems from blah, 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 blah. So I put that in there just because if you look at the stuff that's coming here, breaking Q1 GDP now forecast has dropped -2.8 from -1.5. I think they're just playing with the numbers, guys. They're playing with the numbers. They're going to state that Trump doesn't own the economy yet. That's out 6 to 12 months. They are trying to shift from fiscal spending to monetary bank lending, and they need lower rates to do that. So from this shift from fiscal spending, where they're cutting back on fiscal spending and shifting it to more of the private sector, there could be a slowdown between that shift. And that's exactly what Scott Bessent was alluding to in this move here that I spoke about. And that is the shift from the Senate reportedly indicated that government spending cuts and a shift to private sector growth wouldn't align perfectly at first, hinting at a GDP contraction during this shift. If he's coming out and saying this, then they're messing with stuff in the system because they want lower rates, they want a weaker dollar. They've come out and said, I've heard them say this on TV all the time, or YouTube clips and all sorts of stuff. Here is the S&P 500 free cash flow yield is at its lowest level in over 20 years, probably fine. There it is, way down there. We've got some OPEC members couldn't wait till April. UAE Fed production 500 plus thousand barrels per day above quota. The Kazakhstan Fed production 300 plus thousand barrels per day above quota. Iraq is above quota. In Nigeria, which isn't capped, is 150,000 barrels. They're just coming clean. Those barrels are increasingly difficult to hide. OPEC Plus will go ahead with April oil output increase, is what a lot of the headlines are going around. And I think this aligns with what Trump wants in lower interest rates. Here's Eric Nuttall. He says OPEC Plus to begin gradual return of voluntary barrels to the market in April, with an emphasis on gradual and adaptable, was not the consensus outcome. Despite this output rise, we see inventories remaining below average, with Brent fair value staying above $80 to the end of 2026, in his opinion. And this is the global oil days of supply doing this kind of move there. And then, yeah, we won't go through that there. Coming out, Warren Pies. So he's sharing this, says oil, OPEC Plus capitulates and will move forward with April supply increases. In related news, the 10-year has clear runway to sub 4%. There's your lower interest rate on the 10-year that they are trying to hit. So OPEC Plus to begin long-delayed supply hike amid Trump pressure. It says OPEC Plus will increase oil production by 138,000 barrels a day in April, the first in a series of monthly hikes to revive production halted for more than 2 years. The decision to proceed with the increase comes amid pressure from President Donald Trump to lower oil prices, and despite expectations that OPEC Plus would delay the restart. The move is expected to put downward pressure on oil prices, which have already retreated more than 10% since mid-January and may contribute to a supply surplus of 450,000 barrels a day this year, is what they are expecting and the news that's being released. And I don't know if it's going to result in that or not. I know we're cutting back on production with rig counts going down for oil specifically. I think natural gas is following lower too, to some extent. And we'll see what actually transpires and works at the end of all this. Atlanta Fed forecasting major economic contraction now. It's weird that this is all coming out after Scott Bessent just recently, when I was listening to some of his clips, and you could see his comments from AI, that they need to get these rates down and that there's going to be a transition between fiscal spending and private sector growth. It's a managed economy at this point. I says, holy smokes, the Atlanta Fed just cut the quarter one GDP. Guess again, back on Friday, he cut plus 2.3% to minus 1.5. Today, he's cut it from minus 1.5 to minus 2.8. And then what that's going to do is it's going to drive people, it's gonna drive fear into the market. And that fear, what they're doing is they're trying to direct money away from oil, because oil, when you get a contraction, people generally sell oil. Lower oil prices. And then he went over to OPEC and said, okay, let's get the supply up. It will also lower the interest rates. And their goal ultimately is to lower interest rates. And maybe they need to lower interest rates to float a whole bunch of debt into. So they're creating demand for debt in the system. That creation of demand for debt is coming from tanking oil and tanking yields. And then when people see that, they're more likely to sell the S&P 500, the NASDAQ, and all this stuff. And then if you pair that with Trump's, stuff, he's going to blame it on Biden and this transition between fiscal spending and private sector growth that they're trying to do. He's going to say, well, that's it's all because of the economy before me. So the way that he needs to do it is he needs to do it early in his tenureship, early in his tenure, and then he needs to push it hard now to get everything to kind of crash down, and then he'll claim victory out in the future. Peter Schiff says Eric Trump admits to the fraud. There's been no agreements on a strategic reserve. Your post indicates that it was a planned pump and dump, deliberately leaked when volume was thin to maximize impact. The retail investors you conned into buying the tokens you pumped got screwed. And it says, Eric Trump says, I love the genius of announcing a strategic reserve on a Sunday when traditional markets are closed and Wall Street sleeps. For the first time, retail investors win. Traditional finance better catch up, or it will quickly become extinct. The world no longer runs on a Monday through Friday, 9 to 5. Almost like he's admitting that they pumped this in the low volume area. Guys, this is not good. You don't want this this is horrible. This is absolutely fraudulent. This is not good. No, I don't care about crypto. I'm not in crypto. I have nothing to do with crypto. But a pump and dump on a Sunday, and he's out here like, I love the genius of announcing a strategic reserve on a Sunday when traditional markets are closed and Wall Street sleeps. Are you kidding me? There's no such thing as digital oil. Oil is a necessary input in the production and delivery of every single product and service in the global economy. Ethereum is an unnecessary input for any product or service, adding nothing but friction and higher cost and extra complexity to anything built on it. Anything that can be built on Ethereum can be built without it. And I don't understand the strategic reserve of crypto. I don't get it. We don't need it. It's not strategic in any sense. So, some people say, oh, you just don't understand. I don't think they understand what strategic means. Strategic means that you need it for some reason. The economy needs oil. It's it's correlated to GDP by 0.996, 99.6% correlation between GDP and oil consumption. So if you lose oil, your GDP could collapse. If you lose Bitcoin, nothing happens. It's not strategic. Logan says there are over 162 million people working. Existing home sales improve when mortgage rates decrease with duration. A similar period occurred in the early 1980s when affordability was worse before rates fell due to a recession. Sales rebounded then from extremely low levels, and he's talking about this level here where we came on down in kind of an A, B, C correction. And then we launched again after interest rates started to decline from the 1980-81 peak. And we're at a very similar situation perhaps to that time frame. We've got low inventories. We have low home sales. And those are paired up with the affordability problem. And I think Trump is trying to kick this back off again. And the way he's trying to do it is he's like, well, we can engineer a slowdown, which we're getting all this information of a potential slowdown in the markets. And then everybody basically reacts to it. They react to it and they're like, oh, yeah. We got to sell. And then they drive fear into the market. And that fear drives interest rates down. So it's all being, I think, potentially engineered to some extent, especially with if you look at the dramatic shift here, holy smokes, the Atlanta Fed just cut quarter one GDP guess again. It says back on Friday, they cut from plus 2.3% to minus 1.5%, then they cut it again. Seems a little bit weird that all this is kind of coming out and piecing together all the information. So let's go over some quotes here. Warren Buffett says, for some reason, people take their cues from price action rather than from values. Price is what you pay, value is what you get. Markets are there to be taken advantage of rather than instruct you as what is going on. And here's another thing, because this is a Warren Buffett quote. I'm willing to bet Warren Buffett probably has insider information, and he's obviously stuck over in a bunch of cash. You think those two are somehow related? Then Bissett comes out, talks about all this, that they're going to have a decline in potential GDP between the fiscal and the fiscal spending or government spending versus growth in the private sector. This all seems a little bit fishy to me, guys. It all seems a little bit fishy. Peter Lynch, I don't believe in predicting markets. I believe in buying great companies, especially companies that are undervalued and or underappreciated, says Peter Lynch. Derek Sivers says, money makes problems go away, but it amplifies personality traits. Money won't change you, but it will amplify who you are. So I guess those guys that sniff their farts while drinking wine, and then swifting it into their nose, if they had even more money, does that amplify that? Are they going to be going around just doing it all the time? I don't know. I thought it was kind of funny though. Coal prices are at 4-year lows, but it's hiding a coming global supply squeeze. Thermal coal demand is rising in India and China, outpacing additions in solar and wind. The AI boom is expected to lift demand elsewhere. Investments in new high-grade mines is dwindling. And this is Asia thermal coal prices seen near bottom. Price is still 30% higher than the average between 2015 and 2020. This just, to me, looks like a big back test. So we're going to come down, probably back test the top here, and then we'll see if we can get some momentum to the upside again. But I agree. I think there is going to be a global supply squeeze on energy in general. Grady says the gold versus Bitcoin ratio chart below has a similar setup here now to the last time Bitcoin massively started to outperform gold. Bitcoin had huge weekly bullish reversal last week at probable weekly cycle low, and gold is very due for a daily cycle low. We will get either repeat of red route down move, which equals Bitcoin outperforms, or we get a breakout pink route, which gold outperforms. And yeah, that's the two options there. Do we stay in the downtrend? Now, keep in mind, this Bitcoin was created in a bull market for the NASDAQ after 2008, and that was the bull market ever since. It's never seen a decade of sideways chop in the NASDAQ yet, which it will, I think, coming up very soon. So I think that we're going to see gold outperform Bitcoin here in the short term. If Bitcoin trades like the NASDAQ, because Bitcoin hasn't existed during a down move in a commodity bull market where it's down for tech against commodities. So we'll see what happens here over the next decade with this ratio and what Bitcoin actually does. I think it's just an extension of the NASDAQ. I could be wrong because we haven't seen these market conditions. And see how Bitcoin reacts to them. Um, so that's my opinion there. Here's another one from Grady. It says, "Caught the big breakouts." Oh wait, I hit the thing. 1 second. Coming back. Silver's third turning is unfolding. In the early 1990s, industrial demand for silver surpassed production. The ongoing deficit is the number one reason Buffett decided to step in. The production and reclamation of silver are running about 100 million ounces less than consumption. By 2001, the cumulative deficit stood at 1.2 billion ounces. It wasn't until 2006 that Buffett sold, when the market reached equilibrium. The silver surplus lasted until 2021, when the deficit returned with fury. The combined deficits of 21-22 demolished the cumulative surpluses from the previous 11 years, and it hasn't let up. The three largest silver market deficits in recorded history have been in the last 3 years. Look at the move of this guy. Huge silver deficit. So zero is up here, and anything below zero is running a deficit. So we turned into a deficit in 2020. And ever since then, we've been running pretty big deficits. And it's very similar to the 1990s, these surplus deficits that were running in the 1990s. Lance Lambert says 73.3% of U.S. mortgage borrowers have an interest rate under 5%. Homeowners, at what rate level would you consider selling and buying something else? Well, I wouldn't consider buying something else because of interest rates myself. I would buy whenever I felt there was a good deal. So I'm not looking to buy, but if I found something that was an incredible deal, that's when I would buy. It would have nothing to do with the interest rate. Me personally, that's what I would do. Peter Lynch says, "Wonderful companies become risky investments when people overpay for them," says Peter Lynch. We've got natural gas storage level now below the historical mean. We'll need 21 billion cubic meters more of gas this summer to refill storage up to the 90% full target. This is 2025, and you can see the divergence between the mean and where we are today. Tavi says, "We are on the brink of a global rebalancing, in my view. Historically, when the dollar enters a structural downtrend, hard assets tend to significantly outperform U.S. equities. What is the usual outcome of austerity combined with lower rates? It's a weaker dollar. While fiscal consolidation is essential for restoring investor confidence in U.S. Treasuries and reducing long-term interest rates, one of the most immediate and effective approaches to lowering government spending is for the Fed to cut interest rates itself. This issue likely signals that the US dollar is at a critical juncture in history, and the significance of the chart cannot be overstated. Commodities boom are these bottoms, and then you can see the Plaza Accord tech bubble and tech bubble 2.0 when the DXY rolls over. And I can't help but see, maybe he listens to me every once in a while, because I do talk about this DXY rolling over and commodities moving on higher. Commodities aren't actually going up, it's the currency going down. And what happens in these cycles is that stocks or financial assets become overvalued. When they become overvalued, there's at some point an inflationary push that raises interest rates up and pulls the dollar DXY up with it. As that occurs, it will put pressure on the stock market when interest rates get to a certain level. Then it will roll over because the overvaluation isn't sustained with the increase of interest rates. So the rollover in the NASDAQ and the rollover in the S&P and all that stuff, once it rolls over, they lower interest rates to try to prop it all up. It's too late generally when they lower rates. So you get a big move lower, maybe 20-30% or something like that, or maybe even bigger, depending on the inflation in the system and the interest rates. But I think that's kind of where we're at. You can see here, very similar situation to the tech bubble and tech bubble 2.0. And it's all aligned where commodities are at too. Howard Marks says, when things are going well and prices are high, investors rush to buy, forgetting all prudence. Then, when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. And it will ever be so, says Howard Marks. And that's your psychology. That's exactly what we're seeing today. We're seeing a lot of people sell when they should be doing the opposite. Now, I'm not saying that we're at the total bottom, but at some point when the fear maximizes in the markets, that's generally when you want to buy because that's where the best valuation is. It's all about value, not price. But that's what we're going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special with the coupon code. I'll be releasing a midweek update. Tuesday, Wednesday. So look for that on the website. And that's all I've got for today. So we'll catch you next time. This is Finding Value.